Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio, and today we are going to put spotlight on investing for Gen Z. In a market like this, we're seeing a lot of volatility, but it's important to know the risks, their appetite, and their investment profile as well. So how should the Gen Z start off their investment journey? Should they go for mutual fund, SIPs, gold? There's so much in gold as well that's happening, right? So let's welcome our guest, Shweta, Rajani, Senior Vice President and Head of Mutual Funds at Anand Rathi Wealth, is joining us now to take some questions and make that portfolio for you if you're starting right now. Shweta, such a pleasure to have you with us in the studio. And you know, everyone is out there to invest, but sometimes it's so difficult just to know where to invest, right? So what should the ideal strategy for Gen Z be when they start their investments? First, how should they start? And second, where all should they put their money in?
Sure. Thank you so much, Sonal, for having me here. I think this is very important because we are seeing a lot of Gen Z investors today. But you know, before I get on to the strategy, the first step is actually having your objective in place. So decide your goal. It could be as simple as, you know, getting a car 3 years down the line, so having that 25 lakhs that you need 3 years down the line, or it could be, you know, buying a house. So step one is decide your goal. Once that is in place is where then you can move on to the next step of strategizing. Now in the strategy bit, again, I'm going to break it up into 3 steps. One, know how much is the budget that you can allocate for your investments. Second, get your asset mix right. You know, how much should go into equity, how much should go into debt. That becomes your step 2. And then step 3 is having the right set of products. So, you know, if I have to break it up, that's how I'll, you know, very simply break it up to start. You asked when should they start? I think to get the best benefit of power of compounding, what you need to do is start as early as possible. So the day you start earning, you have your first paycheck, go all in, because the more time you give to your investments, the more time you'll get the advantage of your money doubling or, you know, quadrupling as early as possible. Know the right set of products to invest into becomes very critical, because even into something like as simple as a mutual fund, right? Yeah. There are different categories. Yeah. So knowing which is the right category for you becomes your you know, a step that you need to take in that right direction. So these would, I'll say, you know, as a starter, what you should do.
Always stick to your basics, right? That is the most important. So let's get that started and understand what are some of the do's and don'ts for Gen Zs, because, you know, they are more tech savvy. Their investment principles are very different. They are talking about investing not only in equities, they are like about Bitcoins, they're talking about cryptocurrencies. There's so much. Their savings preference is different. So what are some of the do's and don'ts there?
Yes, this is, I think, very important. And you also mentioned technology. So I would say certain do's. Yes, use technology wisely, right? What I'm trying to say is use technology to enhance your knowledge. That's very important when you're starting. Use technology for your research, for monitoring how your investments are going. That's, you know, one do. Second do, like I said, have your objective in place, you know, when you're setting it. Another do would be to ensure that you have an emergency fund. Yeah. This is something that people tend to miss out on, but this is very critical because it will help you, you know, navigate your investment journey thoroughly. Have an insurance in place. Have a retirement plan in place. So these, I would say, as your 5 do's that you should have. Don't chase trends, you know, just because this is the flavor of the season or something that you're hearing too much. Don't go in for that. Don't overtrade. You know, given that you have a lot of technological access and ease of transacting, do not overtrade. Don't mix your insurance needs and investments. You know, you have to manage it separately. These, I would say, would be the key, you know, don'ts, some things that you should avoid in the portfolio.
The most important is don't just follow trends blindly, because that sometimes does happen because we see everyone else doing it. So are we right now seeing more DIY or do-it-yourself investors in the Gen Z space or the Gen Z generation? Is this the reason we are seeing big growth in platforms like Grow, Zerodha? And is this something which is expected to continue?
You know, you're absolutely right. And I was seeing some data 1 week back that had come, which also spoke about the number of new broking accounts that have been opened. All of that is showing that, yes, today, because you have that ease of access, you have a lot of DIY Gen Z investors also coming in. But actually, that is not really good, because when you're starting off, your knowledge levels are very low. You could, you know, end up chasing the trend because of this. So therefore, it becomes important that either you list down your own financial plan of knowing where you want to go to and do your own homework. If not, then at least, take a guidance of an advisor who can in the initial years guide you so that you have that expertise then yourself and you move ahead. So, where I was saying choose technology wisely, I think it comes in over here.
That's one of the big do's that do, yes, of course, use technology, but be very careful about using that as well. A survey suggested the generation prefers digital gold versus other categories. Do you think that is the way to go, or gold funds or sovereign gold funds, those are the better bets?
Yes, so when it comes to gold, I think here again, if I am just seeing between the different options that you have for gold, you have physical gold, you have digital gold, and then you have the sovereign gold bond fund. It's definitely better to go for digital gold than go in for physical gold. But if I am looking at digital or paper gold that you have as an option, then you would have sovereign gold bond, gold funds, all of that available to you. I think given the way it is, sovereign gold bond then becomes a better choice than just going in for a normal digital gold or a gold fund, because it, one, gives you the advantage of price appreciation that you would anyways get in normal gold. You also get that additional interest rate benefit of 2–2.5% for your holding period. But when it comes to gold, I think it's very important that as an asset class, do you really need it in your portfolio? If it's for consumption, then go ahead and invest, temporarily how much ever you want, because in future you're going to consume it. But if it is for an investment growth, then I would say one should not go beyond 5% of their total portfolio in gold, because it would not give you the kind of appreciation that an equity as an asset class can give you. And because we're talking about Gen Z, you have a longer time horizon. You would have 10–15 years. So almost 70–80% of your portfolio should be equity and rest other asset classes.
Okay, interesting. Only 5% there. I wanted to understand a little bit more about digital gold versus sovereign gold bonds. Of course, you said that one of the reasons why you would look at SGBs is that 2.5% interest that you get. Do you think costs are also higher in digital gold versus sovereign gold bonds? Is that also something where we can see the differentiation?
Yes. So if you're going in for a gold ETF, then your cost would be on the lower side. But then if you're going in for a gold fund, which would be a mutual fund based, gold fund that you're getting, there your expenses would be slightly on the higher side. And then when you go in for a sovereign gold bond fund, there is no expense for it because it's, directly government giving it to you. So in terms of expenses, it's the least. But the downside of a sovereign gold bond fund would be the liquidity, that you cannot exit the way or the day you want to. So it's least on expense, but it comes at a certain cost of liquidity for you.
The lock-in of 8 years is something that would not allow you to liquidate your funds. We get that point. So let's understand something that every Gen Z wants to know, right? It is something very basic again. What should the initial portfolio of a Gen Z look like? Just out of college, starting their first job.
Sure. So I think here again, I'm going to break it up into 3 steps so that whoever's watching us, can understand it. One, when you're starting off, have your income to expense or income to savings ratio. At least start off with saving 20% of your income and then scale it up to 50–60% as you grow. So, have that in place. Second, like I was mentioning some time back, that when you're starting off, you have a longer time horizon, so you can go in for 80% of it being into equity and the rest being debt or, other asset classes. Third, within equity, diversify your portfolio. So don't go in for stocks. You may not have the knowledge. Go in for equity funds where there is a professional who's managing it for you. And there to ensure that, you kind of have a diversity across different market caps to get the expertise of it. You can, maybe start off with 5 funds, and I'll just, give you some names. You can go in for, let's say, a Kotak multi-cap, a Quant value, an HDFC small cap. You can go in for an ICICI dividend yield. So these are, 4–5 funds that you can start with so that you're, getting a different style benefit, you're getting a different market cap benefit to your portfolio. So that's something.
Okay, so that gives you diversification, and of course, as you said, you need to go to an expert as well at the start. Don't be a do-it-yourself investor if you do not have enough exposure to equity markets or investing as well. It's a very interesting chat. We build up on that, but we have to get into a quick break, and on the other side, we'll continue our discussion with Shweta, Rajani. We are discussing everything about where should Gen Zs invest, especially when it comes to mutual funds. So stay tuned for that conversation. Welcome back. You're still tuned into MF Corner. We still have with us Shweta, Rajani. We are discussing where should Gen Z invest and what should their strategy be when it comes to mutual fund investments. Shweta, tell us 5 mutual funds you think would be the perfect fit for Gen Z who are starting investing today into mutual funds.
Yes. So I think, if I have to give you out some names, I will just give you the names first. It's going to be DSP Equity Opportunities. Then you can go in for Quant Value. You can go in for, let's say, an ICICI approved Focus Equity, Kotak Multi-Cap, and then you can go in for an HDFC Small Cap. Now, the benefit of this, basket that I just told you is, one, it's spread across different asset management companies. You wouldn't have more than 20% exposure to a single fund house. They're all managed by different fund manager styles, so you get the advantage of that. And then you get expertise of, investing into large cap, mid cap, small cap. So you're not only looking at returns, but you're also somewhere managing risk by spreading it out.
And you're right, because usually we look at returns, okay, what performed well in last couple of years or what could possibly perform well in future years, but everyone has a different risk profile. So that's very important to understand as well. Let's move a little bit away from mutual funds and try and understand investing patterns or spending patterns of Gen Z. Is it a good idea to use credit cards or personal loans? Should that be a part of their overall finances when it comes to Gen Zs?
So, I would say whenever you're looking at debt or loan, there is always something which is a good debt to have and a bad debt to have. So, taking a personal loan to go on a holiday, I would say would be termed as a bad loan. But if you're taking a loan for your education or home, that is a good loan. But even within there, going in for a personal loan, which could be at a higher level versus something that's collateralized, or, taking a credit card loan, which you would get at 18-20% versus just going to a bank and taking a loan at 11-12%. Taking the bank loan would be a better choice. I do understand with Gen Z what happens is, because you get a lot of points on credit cards or schemes that you get, you're attracted towards using it, but it should be wisely used. So ensuring that, understanding what are the different interest rates that you would have to pay across different loans that you're taking, what would be your EMI schedule, what are the offers that you could get, and how do you ensure that, you're not digressing from your overall rating. Going in for a toss as an individual. These are certain things that one should be mindful of when you are, considering whether you should optimize your credit card usage or go in for a personal or any other loan.
Okay, that totally makes sense. And it was a good way to point it out. There's some loans which are good, there are some which are bad. You just have to be able to identify that very carefully when it goes to your credit card loans or general loans. In that case, let's go to your first answer. You spoke about some steps one should follow when they're starting their mutual fund journey. And one of them was emergency funds. How important are emergency funds, Shweta? And what amount should be set aside for them every month or every year?
Yes. So, let me tell you what emergency fund does. It gives you the courage to navigate a volatile market. It helps you navigate a period where you would be, struggling with your jobs because you're also in your initial phase. It could help you navigate a medical emergency that happens. So, therefore, an emergency fund is needed. How much? I would say ideally, just 6 months of expenses that you would generally have should be kept in an emergency fund. Where should it be? It should be in something which is liquid and something that can be accessed very easily. So, something like a liquid fund or an overnight fund where you've placed the redemption request today and you will get it in the next day, that should be your emergency fund.
Okay, all right. So there are some mutual funds as well which will help you here. Those are the short-term funds, be it liquid funds or arbitrage funds as well, right?
Absolutely.
What are some of the mistakes now that Gen Z is making? And that is a big no. You would absolutely go against that.
So I would say the biggest mistake that one makes is not having your goals laid down clearly. It's like you've not decided what your destination is, but you've taken your car and you've just started driving on the road. So that's the biggest mistake. Ensure that you don't do this. So have your goal mentioned in place. Second, again, we were just talking about emergency funds and not having an emergency fund in place. Third, I would also say not ensuring that you have enough insurance, whether it's medical or a term plan in place, would be mistakes that generally people make, which should be avoided.
Okay, so is investing in physical real estate a good thing to do? What do you suggest Gen Z should do here?
So here again, when you're talking about real estate, it could be either for a consumption in future or it could be just for an investing. Now, if you're considering real estate from a consumption standpoint, it's always good to do a math between paying a rent and buying a house and paying your EMIs. Most often what I have seen is going on rent turns out to be a better option than buying a real estate there. As far as an investment real estate is concerned, now I would look at how the demand supply has been for real estate, and it looks like if you're investing in real estate, you won't end up making more than 5-6% return. And generally in India, you consider two asset classes, equity and real estate, as growth-oriented asset classes. So if I'm looking at those two options, then I would say rather than investing in real estate, you should look at equity funds or equity as an asset class. Now, within that, if you still want to take a real estate exposure, I would say you'll have some real estate companies that you can invest into. So if you understand that sector well, then doing that would be a better choice than just buying a real estate at this point.
Okay, and what about REITs? Because suddenly there's a lot of interest there as well.
Yes, so you have 3 or 4 REITs in India, and they have emerged in the last 3-4 years, which give you a decent rental yield plus an appreciation. But the problem again there becomes liquidity. To a certain extent, and they're very volatile in terms of the return that they could generate. So it's avoidable. You rather be in equity, leave it to a professional manager, or take exposure to real estate funds or stocks.
Okay, all right. This is a question that I have received from one of a friend of mine, and they say a large portion of Gen Z, they get into F&O trade, as we are seeing right now. That's the trend. What is your advice to them? Should they just go for that or just stick to an index fund?
Yes. So sometimes, what happens generally with a Gen Z is they're attracted to anything that is new or something that could give them a sudden good return, and that's what F&O does for you. You could make a significant return in one day, and you have, depending if you're going in for a future or an option trade, you could have 1 day expiries, 1 week expiries. But what's important when it comes to F&O is you also understand that it comes with a higher risk to your investment versus just buying a simple stock in the cash market, and it's a complicated segment. So if you've not thoroughly understood it, trained it on a paper portfolio, don't go and actually trade it. So F&O for a Gen Z is, I would say, avoidable, and if you are going in for the trade, ensure that you have your stop losses in place so that if you think that you are exceeding that limit, you go put a stop and reverse your trade. So that becomes very important, and it's more important in F&O than you just holding a stock in the cash market.
Okay, and it requires a lot of training. It does require supervision. But again, for the benefit of our viewers, Gen Zs are those who are born between 97 and 2012, right? So we were talking about it, but those are the ones aged between 11 to 26 years. And let's just hope the ones from 11 to 18 are not getting into all this right now, and the parents are making those decisions. We just got the AMFI data as well, so I just wanted to quickly discuss that with you because it's record high SIPs yet again. We're talking about it happening at a time when there were these KYC norms which possibly could have hampered the SIP numbers. What are you making of the April data, and which category really stands out for you?
Yes. So I had 2-3 observations when I saw that data coming in. One, SIP continues to have an improving trend, and to my mind, I also look at this in conjunction with the household savings data that RBI publishes, once in a year. And that shows that there is a shift in the investment pattern of a household where if, 10 years back, almost less than 1% was getting invested into equity. Today, that's almost 7% getting invested into equity. So, rather than having your monthly recurring deposits, it's shifted to having an SIPs in place. So that, I think you will see the trend continuing. It's 20,000, it will go to 21, 22. That's very much a possibility. Second, if you see in terms of categories, where the money got allocated, small cap saw a reversal. So it clearly, there was a certain stress where March people were worried about the stress test that AMCs had to declare and what could happen in terms of valuation. But it's clear that there are no concerns in that segment. So people are looking at, mid small cap again, and that again could continue. A third, large cap, pure large cap as a category. People are shifting from pure large to being in categories like large and mid or flexi, which are also equity heavy or large cap heavy. And they have a higher potential in terms of outperformance, than a pure large. So these are few changes that you may see in the next few quarters, as well.
Oh, okay, very interesting. And as you pointed out, they're equity heavy and people just want to invest in equity schemes, and that's been the trend. And of course, the SIP trend was up for you on the screen, more than 20,000 crore rupees. Just few months back, we were talking about $2 billion, so it doesn't seem like it'll be far away when we'll touch that $3 billion mark on the SIP. So the power of retail investors, be it any sort of FII selling, buying, retail investors are on course, right? And that's what's happening with the mutual fund industry as well. Shweta, it was such a pleasure having you with us on the show today and making these things so easy for the Gen Zs, and hope that helps them take up that first step in their investment journey as well when it comes to mutual funds. Thanks a lot.
Thank you. My pleasure.
Okay, all right. With that, we'll do one thing. We'll take your leave on this show today, but stay tuned for Closing Bell to take you through the last hour of trade.